Good afternoon and welcome to the Anatomy of a Recession third quarter update. My name is Lindsay McCullough and I'm a member of the business development team here at ClearBridge, and I'm thrilled to be joined by our investment strategists Jeff Schulte and Josh Demner. Just a few items here before we begin. Our format for today's call will be a half hour or so of prepared comments, and then we'll be switching gears to a Q&A session. We have some questions come through during the registration process, but in the event that you have a question pop up, please feel free to use our chat feature and submit your questions, as we want to keep this as conversational as possible. For those less familiar with ClearBridge, or to serve as a refresher, we are a global equity manager and run the gamut when it comes to equities, so from US to non-US and across that market cap spectrum. We also offer infrastructure capabilities as well. ESG research is fully integrated across our strategies, and on that note, the firm did sign the Net Zero Asset Managers Initiative earlier this summer. At the end of the second quarter, we managed about $198 billion in assets, so just shy of that $200 billion mark. Jeff and Josh, I know our 2Q webinar was focused on the reopening and the jobs market and of course inflation, so I'm happy to turn it over to you guys, discuss your thoughts on US markets and the economy as we really continue into the second half of the year here.
Great, Lindsay. Thank you. And good morning or good afternoon, everybody. I appreciate you joining the third quarter update here of the Anatomy of a Recession. Hope everybody's had a safe and enjoyable summer so far. And we're going to be going through quite a number of topics as the markets continue to keep us on our toes. We're certainly going to talk about the economic outlook for the U.S., how that's changed at the margin. Touch on some of the risks, higher inflation rates, the Fed tightening cycle, the possibilities of a correction, and then also opine on our views on the growth value debates. Before we get into the U.S. outlook, I want to kick it over to my partner, Josh Demner, to talk about what he's seeing with the recession risk dashboard and what are the potential implications for the U.S. economy. So Josh, take it away.
Thanks, Jeff. As you can see on the slide in front of you, the dashboard is fully green right now. We have an overall expansionary signal, and all 12 underlying indicators are showing green or expansion as well. The overall readings are among the strongest in history of the dashboard, and that probably isn't all that surprising given the latest GDP reading came out last week at 6.5% for the second quarter. This was the strongest print in just under 20 years, going back to about 2003. And currently, consensus is for an acceleration in the third quarter to just over 7%. I think it was 7.1% when I looked this morning. I think it's pretty safe to say that the economy is heading in the right direction currently, and the dashboard is really reflecting that. I'll turn it back over to you, Jeff.
Great, thanks, Josh. And obviously, we've had very robust growth here in the U.S. Josh alluded to the best quarter since 2003. Depending on how Q3 comes in, it may be the best quarter that we've seen since the early 1980s. And one of the reasons why we're seeing so much robust activity in the U.S. is because of the stimulus efforts of not only the Fed, but also Congress. And you can see here that there's more fiscal support for the U.S. economy in 2021 because of that CARES package back in March than versus 2020, even though the unemployment rate is close to 10 percentage points lower. And there's a fear out there from investors that as we reach 2022, we're going to see the largest fiscal contraction since 1947, a contraction of around 9% of GDP. And even if we get the entirety of Biden's fiscal package passed, that fiscal cliff is going to be 8.5%, or roughly $2 trillion. Now, I certainly empathize with this point of view. $2 trillion less of spending is quite a bit of money, but I believe that there's more than enough offsets to keep the U.S. economy growing above trend as we move through the next couple of years. And one of the core views that we've had and why we think we're going to continue to grow above trend is that consumption is going to remain robust. Now, if you look at total excess savings compared to pre-COVID levels, consumers in the U.S. have accumulated $2.6 trillion. Now, if you look at the personal savings rate as of June, it's at 9.4%. That's still 2 percentage points above pre-pandemic levels. So total excess savings continues to move higher and higher. But as we reach the end of this year and the early part of 2022, I do believe some of these excess savings will be drawn down in a lot of the areas that have seen the biggest contraction of spending, especially in the services sector, re-engagement with hospitality and leisure. It's not just the U.S. that has excess savings. If you look globally, households have accumulated $5 trillion of excess savings. In Canada, they've accumulated 12% of GDP. The UK has been 10%. China, 5%, the Eurozone, 4%. And as the global economy reaches herd immunity and deals with Delta, you're going to see higher consumption not only locally here, domestically, but internationally as well. But also, it's not just excess savings in the U.S. That are going to make its way into that above-trend consumption story. That's the first leg of the stool. The second leg of the stool is obviously households, housing prices. Housing prices are up 18% year over year. That's a record gain. And given the scarce supply of homes, it's going to keep a floor under home prices as we move through the next couple of years. But the third leg of the stool has been robust financial markets. And you can see here that household net worth versus the end of 2019, which was before the COVID recession actually happened, has risen in the U.S. by $25 trillion or 23.8%. A very different dynamic than what you saw going through the dot-com bubble and then also the great global financial crisis. So this is going to underpin a higher consumption story for the next couple of years. The other part of the consumption story really centers around the labor markets. And on the left-hand side of the left-hand chart, you can see that the job openings have literally skyrocketed over the last year. In fact, you have record job openings right now of 9.2 million. Very different dynamic than what you saw coming out of the global financial crisis. So there's ample opportunities for people to assimilate back into the labor force should they want to. And the reason why we think we're going to see above-trend job creation over the next 12 months is the chart on the right-hand side. That since the February peak of payroll last year, 5.2 million or 75% of the job losses have occurred in COVID-sensitive industries. So as you see a continued reopening, a re-engagement with the services side of the economy, we're expecting above-trend job creation. Now, you had a bit of a payrolls miss in May. That miss was reversed in June. June was a very healthy 850,000 jobs created. But given the ADP job number this morning, you may have a little bit of a disappointment here in July. It came in at 330,000. Now, ultimately, I don't think it's going to be a very disappointing job creation environment. I think over the next 3 or 4 months, you're probably going to have job creation somewhere in the 1 million per month range. And the key reason why I think that that's the case is if you look at the 26 states that have ended federal unemployment benefits, that's freed up about 3.5 million individuals. As we get to September 6th and the other 24 states end their federal unemployment benefits, that's going to free up another 6.5 million individuals. So you have 10 million people assimilating into the labor force over the course of 2.5 months. Now, the drop in the Republican-controlled states where they already expired those unemployment benefits, the drop in the initial jobless claims and the continuing jobless claims has not been as strong as I has been anticipating, but nonetheless, I think as we move into the fourth quarter, you're going to see much faster job creation as people turn to supplement their income needs and their spending needs in the fourth quarter. One thing that I also mentioned here is that you've seen very robust wage growth. Wage growth is well above pre-COVID levels. Obviously, you've had a tight labor market. Companies have had to attract the right labor through either higher bonuses or higher wages. You've seen longer hours worked. And if you think about the biggest driver of consumption, it's not fiscal stimulus. It's obviously household net worth and wealth certainly helps, but the biggest driver of consumption tends to be compensation. And with higher wages and very strong job creation, I think consumption is going to remain robust again over the next couple of years. But we are reaching the point of the cycle where we're going from early to mid-cycle, the handoff from consumption to business investment. And business investment is going to manifest itself in 3 distinct areas. The first is the chart on the left-hand side. We've been talking about this for really the better part of 8 months, is that we've been expecting a massive inventory restocking cycle. And after 8 months, you can see that we're actually closer to the beginning of that cycle rather than the end, despite significant efforts to restock. In fact, we're approaching the levels, the all-time lows of inventory to sales ratios that we saw back in 2011. If you look at first quarter GDP growth and second quarter GDP growth, the biggest driver of that underperformance of those two data points was the fact that you saw a drawdown of inventories. And as you reach the back half of this year and into early 2022, you're going to see a restocking of inventories, higher manufacturing activity, higher GDP growth, all things considered. But the next driver of business investment is really going to be through higher CapEx. And the reason why I think we're going to embark in a very large CapEx boom, one that we haven't witnessed in a couple of decades, is because if you look at the regional Fed surveys, they're registering aggressive investment intentions in the U.S. My favorite Fed survey or regional survey is the Philly Fed. You look at their CapEx intentions, and the reason why I like the Philly Fed is it's the survey with the longest history. It hit a very robust 41.2 in July, which is the best that we've seen since 1984. And there's a very strong correlation between CapEx and higher GDP growth. And since we're going to have the highest GDP growth, arguably in the last 4 decades, that bodes very well for stronger CapEx activity. But the other reason why I think CapEx is going to be above trend and could surprise a lot of investors is that in the pre-COVID world, that was a world that was constrained by demand that had plentiful supply. As consumers were deleveraging, banks were deleveraging, businesses were trying to rein in their costs to deal with this new environment. And with the reactivation of fiscal policy, it really has changed that dynamic. The other reason is that the crisis has exposed the vulnerability of global supply chains. They're only as robust as the weakest link. And Toyota recently observed that it takes 30,000 components to make a car and only one component not to. So obviously, a rejiggering or reorientation of global supply chains is going to be good for CapEx. Also, with the supply of labor being relatively limited and rising labor costs, makes it even more attractive to substitute capital for labor. So based on all of these dynamics and the fact that there's more visibility on trade wars and the relationship with China, I think it gives businesses the confidence to embark on a large CapEx cycle. And the last reason, which I think is probably a pretty important one, is the chart on the right-hand side there, is that you can see that there's a very strong relationship between earnings and non-residential CapEx, with CapEx trailing earnings by 1 quarter, and with earnings continuing to outperform to the upside, this will bode well for stronger CapEx trends. So as we look to 2021, based on the miss that we saw in Q2, we're in line with consensus with what we think economic growth will come in this year at around 6.5% on a real basis. But as you look out to 2022, I do think that consensus is a little bit too bearish because of that above trend consumption that we talked about. Obviously, a inventory restocking, a robust CapEx cycle, but also we expect the Democrats to pass not only we expect Congress to pass not only the bipartisan infrastructure project, but also the reconciliation bill that's going to pass a portion of the Biden American Jobs and Families Plan, which should incrementally add about 40 basis points to next year's GDP growth. So all in all, the economy is playing out exactly as we had anticipated just a couple of quarters ago, but we do see incremental upside to growth in 2022. But it doesn't mean, obviously, that there aren't some issues or some fears to be concerned about in the marketplace. And probably one of the biggest issues that we've all had to deal with over the last 6 months has been inflation. Is it transitory or is it more structural in nature? So to talk about inflation, I'm going to turn it over to Josh to give our views and how we see that playing out over the next year or two. So Josh, take it away.
Thanks, Jeff. And our conversations with both portfolio managers and analysts at ClearBridge, as well as our clients, as Jeff just mentioned, inflation has been the dominant topic by a long margin over, I'd say, even the last 12 months, not even just the last 6. And somehow I don't think that's really going to change in at least the next 6 months, if not the next 12. I would love it to. I'm ready to move on from talking about inflation all day, every day, but unfortunately, I think it's going to be here to stay for a little bit longer. I think it's interesting, for all the fear and worry, inflation expectations remain actually rather moderate. They've come up. There isn't really a single way to measure inflation expectations. You hear people talk about business inflation expectations, consumer inflation expectations, investor expectations, a number of others. The Fed recently put out a kind of an aggregate, taking like 20 or 30 of these, I forget the exact number, and plugging them into one metric. But I think the two that we tend to focus on the most are up on the page. On the left-hand side, you have consumer inflation expectations. On the right, investor expectations. The consumer inflation expectations on the left side, I think that they have risen over the last few months, but if you look, they're really only back to levels that were actually quite typical up until about the mid-2010s, between 1998, and 2014. We averaged 2.9% inflation expectation from University of Michigan Consumer Survey on inflation expectations over the next 5 to 10 years, and we're just getting back to that level now. We talk about the investor inflation expectations. There also has been a rise. It picked up from about 2% coming into the year to something peaking out just a little 2.75, right in that range. So we had a meaningful rise between kind of January and May in investor inflation expectations. And these are break-even inflation expectations that we're looking at. So this is actually priced by the market. It's the inflation rate that we would need to have in order for a TIPS or a Treasury inflation-protected security to have an equivalent yield to a Treasury bond. Now, what's interesting to me is that when inflation expectations peaked out on break-evens on that right-hand chart, it was right in mid-May. And what happened in mid-May was two things. The first is that we had that kind of very strong CPI print. It was the first time that we had a really big number on consumer prices coming out. But even more importantly, in the days afterwards, really in the week or two afterwards, a number of different Fed governors, Fed officials came out and talked about, well, we're not here with our head in the sand. We'd be willing to act more quickly to renormalize policy if needed. It was sort of the beginning of the talk. It was the thinking about, tapering. And inflation expectations have really stalled out since they've come up. They've come down, but we've kind of moved on from this really dramatic run higher. And we're at levels that currently around 2.5, 2.6. They're high, but they're not crazy elevated. They're I think pretty tolerable and manageable given where we are in the economic cycle right now. I also think it's important to look at inflation right now in the context of actually the pandemic itself. There was a period back in the spring of 2020 when we had outright deflation, that is, prices were actually falling. And then as things reopened in the summer of 2020, and then again really in the spring of 2021, when vaccines started to become more widespread and people were willing to venture out to a greater degree, we've had a series of pretty strong inflation prints. Now this creates distortions when you look at inflation on a year-over-year basis. But if you look at inflation on a two-year basis, that is, what has inflation been annualized over the last 2 years, it removes some of this noise or some of this impact. On this basis, yes, as you can see, inflation has been on the rise, but it's really, kind of making up for the weakness that we saw in 2020 that I was talking about a second ago, when inflation really on a two-year basis was nothing to worry about because of that period of weakness. Equally importantly, the levels that we're at are a lot more tolerable on this basis. And if you plug in current consensus, which is the dotted red line on the right-hand side of the chart, inflation looks like it's hopefully going to start to stabilize in the back half of 2021. I think this would be a very welcome development for equity investors. Another way that we think about inflation is to look at what is driving inflation. So there's a lot of ways you can do this. You can look at specific categories, and used cars are, I think there's been a lot of headlines that used cars are driving a disproportionate amount of inflation right now. That's true. Hopefully that'll start to go away as both the semiconductor shortage eases, and also at a certain point, I think most people who want a car or sort of have one, hopefully. And it makes sense why people were more willing to buy a car and to pay up for it in the pandemic. There was a shift away from public transportation, but I think that's sort of more of a one-time issue. Another way we look at this is looking at the category of inflation, but things that adjust quickly or categories that prices kind of move more slowly. So the Atlanta Fed tracks what they call sticky and flexible price CPI. Sticky price is those slow-moving categories I alluded to. It's the dark line on the chart. And flexible prices move obviously more quickly. It's the kind of blue-green line. As you can see, the flexible prices are really what's driving inflation higher right now, and that tends to be shorter-lived. We've had periods over the last 30 years where you have spikes in flexible CPI, but you also tend to see it come back down subsequently. It happened in 2002 or 2009, for example. This is just another thing that we look at that kind of makes us a little more comfortable with the inflationary risk that's out there, and we think that as we move into 2022 and beyond, hopefully we'll start to see some of these flexible prices come down, which will ease the overall inflation readings. A final common worry that we hear from people we talk to is around margin pressure. The worry is that companies will be facing higher input prices and they won't be able to pass them along to their consumers, and that's going to squeeze margins, and ultimately that's going to hurt equity prices. We looked into this, and we actually think there's a little bit more to the story. So what we did is we looked at the difference between consumer prices, or CPI. That's really flipping it around. It's the price that a consumer pays, but the other side of that, it's the price that the businesses receive, right? That's sort of coming into their pockets. And what businesses pay is, a proxy for it would be PPI, or the producer price index. It's what businesses have to pay out to get the goods that they buy and work their magic on them and sell on to all of us. And when you look at the differences between these two measures and how it changes over time, I think you get a decent read on, are businesses able to pass along costs? And if so, are they able to do it to a greater or a lesser degree? And it lines up pretty well historically with changes in corporate margins going back over the last 30 years. It's important to note there's a 3-quarter lag to this relationship. Businesses don't just pass along costs on day one. They tend to find ways to try to, they may have some more stock in inventory that was bought at a lower price, so they don't need to raise prices on day one. But over time, this relationship lines up decently well. I think what's really interesting is if you look at the dark line, that is that difference between consumer and producer prices, the change in the difference between consumer and producer prices. That actually suggests that corporate margins should improve over the next couple of quarters if this relationship holds. I think even if you don't trust this relationship, you're still skeptical, I think we're seeing that margins are improving. Some of this is just the economic recovery is taking hold, operational leverage is kicking in, we're in a period of strong growth, and ultimately I think we're a little bit less worried on margins than most of the people we talk to. Jeff, I know you had one more comment you wanted to make on inflation, so I'm going to stop here and I'll turn it back over to you.
Great, thanks, Josh. And obviously, judging by the muted reaction from the Treasury and the inflation markets, it does appear that participants are quite comfortable with the notion that this impulse of inflation will indeed be transitory, which is a view that Josh has alluded to that we share here at ClearBridge. But there may be a more protracted transitory type of environment that we're going to see than investors are prepared for. Possibility that price pressures are going to get worse before they get better. We obviously looked at the inventory situation a couple of slides ago. It's gone from bad to worse. You're seeing supplier delivery times, order backlogs, you're seeing production materials all delayed, and given the fact that a lot of countries around the globe are still dealing with Delta, shutting down their economies, I don't see this reprieving or rectifying themselves over the next couple of months. The chart that you see in front of you is a really important one and shows you that 47% net of small business owners per the NFIB Small Business Survey, which is the premier small business survey in the U.S., are raising selling prices, the highest that we've seen since the early 1980s, and there's a strong relationship between this gauge and CPI, so we may not be out of the woods quite yet. Also, we've seen persistent price pressures in goods sectors, whether it's cars or furniture, but you're all starting to see services inflation bottom, and you're starting to see prices pick up in areas like travel and hospitality, so it's no longer of an offset. Same can be said about rents or the shelter component of CPI. If you look at rent or owner's equivalent rent, depending on which version of inflation you're looking at, these measures usually lag housing prices by 15 months. And obviously housing prices started to move up dramatically 15 months ago. It means that this is going to add to inflation in the near term. So given the fact that you have these supply chain disruptions, you're still having issues with the Delta variant, I don't think that these supply chain issues are going to alleviate themselves before Labor Day. I think Christmas is a more realistic expectation. So we may see a more protracted transitory type of environment, which ultimately could create a situation where the markets have a little bit of volatility as we make our way through the back half of this year. The other thing that's really perplexed not only us, but I'm sure everybody on the call here is what's been going on with the 10-year Treasury. 10-year Treasury is not showing the same type of reaction as what you're seeing from credit markets, commodities, and equity markets. And if you think about studying the markets, it's a little bit like golf, horse betting, or love. Once you think you've got it all figured out, the face reminds you how little you knew in the first place. And obviously, in the very beginning of the year, in the first quarter, the 10-year Treasury doubled. In the 4 months since then, the 10-year Treasury has lost 55 basis points down to 1.2% this morning. And I think what's going on in the 10-year Treasury market is more technical, but also has some fundamental issues associated with it. And the chart in front of you shows you that the Treasury net issuance versus Fed purchases on a 3-month moving average, and Treasury net issuance has collapsed really over the last 4 to 5 months, and it's the lowest since just before the pandemic. It's a third of the levels that we saw in January, and basically the Fed has been taking down all of the net supply recently. Also, the Treasury overfunded itself back in 2020 at the onset of the pandemic, and its balance at the Fed shot up to $1.5 trillion, and it remained relatively high for really the year following the pandemic. But once the Biden CARES package started to be dispersed and the money was dispersed, it was derived from running down the balance at the Fed rather than issuing bills out in the marketplace. And when that money hits the end user, it usually ends up as deposits back in the banking system. And there's a strong relationship between bank holdings of treasuries and bank deposits. Bank deposits lead bank holding of treasuries by 12 weeks. So if you think about the rally in the treasury market, it really started to intensify in mid-May, which is about 12 weeks after that money was dispersed from the CARES package. So it's possible that a lot of the move that we saw was due to the lagged impact of the Biden package and the increase in bank deposits. Now, the good news is that the Treasury balance is now safely at about $650 billion at the Fed, but also there's going to be a lot more Treasury issuance coming to the market over the back half of this year, and especially if we get the Biden administration's packages passed here sometime in the fourth quarter. So this effect, or this technical effect, is going to start to wane. A couple other reasons why, obviously yields could be down. The first is clearly the Delta variant and some concerns about slower global growth, maybe some possibility of shutdowns. Now, the reason why I don't think that this is a good driver, or the real reason why you've seen yields drive down, is you haven't seen much movement in the high yield space. If you look at the ratio of copper to gold, which are tightly correlated to the rates markets, they flattened, but they haven't collapsed. But maybe most importantly, if you think about the 55 basis point drop in yields since March, it's been a 1-to-1 ratio with a slide in real yields. If you put that differently, inflation expectations have been stable since late March. And if you were going to see a very strong growth scare, or maybe even a recession scare, inflation expectations would be dropping much more quickly. And that's not the environment that we find ourselves in. Another reason, obviously, why the 10-year Treasury moved down, especially in June, was the bond market was starting to mull over the possibility of the Fed making a policy mistake. At the June FOMC meeting, they went from 0 rate hikes in 2023 in the dot plots to 2 rate hikes. There was concern that the Fed was going back to their standard approach of preemptively fighting inflation. At the end of the day, I think that was just a Fed miscommunication. I think the Fed remains firmly committed to their inflation and employment mandate, and more importantly, to that average 2% inflation target that they're looking to achieve. But that's obviously another reason why the 10-year Treasury dropped. And the last two reasons is the bond market in the U.S. really doesn't operate in isolation. It's strongly influenced by global conditions, right? You've seen COVID outbreak in Japan. You've obviously seen the Eurozone have some issues with coming back online. Obviously, China has delevered fairly aggressively on the fiscal and monetary side. And if you think about extremely low bond yields around the world, that usually has a role to play in keeping Treasury bond yields at bay. So you've seen weaker global growth, and the 10-year Treasury is really the global bond that people tend to prefer. And lastly, the U.S. bond market has been strongly influenced by Chinese credit conditions over the last decade, and with total credit creation contracting, it's obviously a good reason why you've seen a sharp fall in bond yields. But the PBOC, the central bank over in China, did a rate cut of 50 basis points here recently. It does appear that they're starting to reverse the ship. So ultimately, I think that the 10-year Treasury has dropped for mainly technical reasons, but also weaker global growth and what's happening in China have been positive drivers to keep yields moving lower. But the reason why I don't think that we've seen the peak in the 10-year Treasury for this cycle is this slide right here. Market leadership is inconsistent with rates. And if you look back to the last cycle peak that we had in the 10-year Treasury, it was the fourth quarter of 2018 when the 10-year Treasury hit its cycle high of 3.25%. In that environment, or during that time frame, cyclicality had peaked months earlier, and market leadership was very defensive. You had utilities and consumer staples at the top. Right now, with this most recent move of 55 basis points down in the 10-year Treasury, you can see here that there isn't really any pronounced leadership of the defensive corners of the equity markets. At the end of June, consumer staples and utilities were the worst two performers, and they've made up a little bit of relative performance over the course of July, but they're still very much underperforming the S&P 500. So the conclusion that I'm getting from the equity markets is that we haven't seen the cycle high in rates quite yet, and we're going to see rates rise as we move through 2021 into early part of 2022. One of the catalysts for higher interest rates obviously could be the start of a Fed tightening cycle. This is every Fed tightening cycle since 1980, and you've usually seen the 10-year Treasury bottom 1 to 2 months prior to the start of that tightening cycle. Obviously, with tapering commencing likely in the next 6 months, the 10-year Treasury could follow a similar path going forward. Also, if we do get to the tightening cycle, which I think is upon us, you could see a little bit of market volatility. Again, this is the last 6 tightening cycles. That blue line is the average move of the S&P 500 during those tightening cycles. And at the onset, markets have a tough time moving forward for the first 10 months of that tightening announcement. But once you get through the first 2 months, basically, 10 weeks, I should say, 2 months, you do see the markets continue to move higher as the economy continues to grind forward and earnings continue to move forward as well. But it does bring up an interesting point of consideration, is that we think that we're probably at the point of the cycle where the market may need to digest some gains. And we're looking at every bear market here since 1967, And at this point, it's usually been about a 6-month period before the market resumes its upward trajectory. And although the S&P 500 is trading well above the average gain where the consolidation typically occurs, I think it's important to remind ourselves the unique nature of this recession and the fact that policymakers have aggressively supported the economy, which resulted in minimal structural damage. If you put that differently, I don't believe that financial markets are poised for a larger than usual consolidation if we get a consolidation based on the returns that we've experienced from last March's lows. And in fact, if you look at that dotted line, this period of digestion may have already begun with the S&P 500's upward trajectory slowing meaningfully since the middle part of April. So history suggests that there may be further to go with this digestion period. So obviously the digestion could be because of a more protracted transitory inflationary environment. It could be higher interest rates. Two of the stumbling blocks that people have been talking about here recently are the twin peaks: peak economic activity and peak earnings growth. We don't think that these are as big of concerns as what you would normally associate with the twin peaks. And let's talk about the first of the two, which is peak economic growth. Now, if I was stuck on a desert island and I only had one economic data point with which to make an investment decision with, it would be manufacturing PMI. Why? If you look on the left-hand side chart, manufacturing PMI leads economic activity by 2 quarters, and it's done an excellent job of foreshadowing not only GDP peaks, but troughs since 1950. If you're not familiar with manufacturing PMI, all it is, it's a survey given to manufacturers asking them how business conditions are, but also how business conditions look to be in the future. It's a diffusion index. So 50 marks the level that's neither expansion or contraction. If you're above 50, it's expansion, positive GDP growth. If you're below 50, it's contraction. You're likely flirting with a recession. And any reading above 60 is considered as strong print, and it's usually consistent with a peak economic activity about 2 quarters later. And it's a key reason why financial markets key off of manufacturing PMI and look at it as a harbinger of what's to come with the economy. Now, manufacturing PMI likely hit its cycle peak in February this year at 64.7. And there's a lot of participants saying this is as good as it's going to get. We're going to have a market correction. And the reason why people think that way is that since the end of World War II, there's been 36 peaks in manufacturing PMI. And if you exclude the episodes where that peak ended in a recession, which is the environment that I think that we're in at this point, the S&P 500 has sold off around these peaks by a median of 8.4%. And while it's true we've likely hit a peak of manufacturing PMI in February, we've either hit a peak in GDP in the second quarter or probably more likely the third quarter, I think it's important to remember that knowing the macro playbook is very different than understanding fully why the relationships have worked in the past. And the relationship is different this time because the decelerations that we're going to see is merely a result of abnormally high levels of growth that were reached as we lapped the base effects of last year's lockdowns. There's very different market implications when manufacturing PMI and consequently GDP is high and stable compared to high and falling. I like to think of it as we're plateauing with economic activity. We're going to have high economic activity for the back half of the year rather than having a cascading down or deceleration of economic activity. So to illustrate that point, if you look to the right-hand side chart, we looked at every instance where manufacturing PMI was above that 60 level. And what was the change in manufacturing PMI over a 3-month period? Now, if manufacturing PMI continued to move higher, obviously on the left-hand side of the chart, you can see that it had very positive market implications. But our core view has and continues to be that we're in that blue shaded area with manufacturing PMI being stable or slightly decelerating. And we've actually been in that stable bucket, which is a key reason why the markets have melted up over the last 6 months. You only really start to see a market sell-off if you see -6 move in manufacturing PMI over a 3-month period, which is a large deceleration of economic activity. So again, knowing the macro playbook is different than fully understanding why the relationships have worked. And the relationship is different because we're going to continue to have very strong economic activity in the back half of the year. The other peak that people are concerned with are peak earnings. And again, I don't think that this should be interpreted as a negative for stocks, at least not like you normally would. Because of that strong economic activity, it's going to help forward earnings projections keep advancing. And I don't think revisions are going to move persistently back into negative territory anytime soon. And two of the biggest considerations that you need to make when assessing the market's vulnerability to an earnings peak are A, the likelihood of a recession, but B, what's the strength of earnings in that year following that peak? Neither are an issue today. A double-dip recession, in my opinion, appears very unlikely. And also, if you look at the bottom of that chart in the blue shaded area, you can see that earnings growth is going to be very robust at 22% over the next year. And what we found is that if earnings can grow at 10% or greater following that earnings peak, you have a very different experience than when you're below that 10% threshold. So all the 10% plus instances are shaded in dark gray. On the right-hand side, you can see when that shaded area, when you're above that 10% bogey, your next 6-month returns are 4.2%. Your next 12-month returns are 11.2%, which are well above the long-term averages. Look right above that. When you're below that 10% threshold, very different experience. Your next 6 months return are 40 basis points, so you have a lot of choppiness, probably a large drawdown in there. Your next 12-month returns are 5.4%. So again, knowing the macro playbook is different than fully understanding why the relationships have worked in the past. And although I'd normally be more concerned with the Twin Peaks, given the unique nature of this recession and its recovery, we're not as concerned as we have historically been when we've reached this point in the economic cycle. Now, the last reason why you could see a little bit more of a consolidation is we're obviously moving from early to mid-cycle. When you make that transition, you usually see PE multiples contract by about 10 to 20%. Now, we've already contracted about 8%, but we weren't concerned about valuations like a lot of people were back in January. And if you happen to be on our January call, you may remember this slide. The reason why we weren't concerned is usually in the first 9 months of a new market cycle. You can see in the shaded bars, whether it's the tech bubble, global financial crisis, or COVID. In the first 9 months, most of that the market return that you see is driven by PE multiples moving higher and not earnings, because the market tends to anticipate the earnings that are coming. Once you get through that 9-month period, the pendulum shifts to the other direction, and earnings really drive the market forward over the subsequent 3 years. All the way to the right-hand side, even though we only have 6 months worth of data, you can see that earnings have really driven the market's return so far this year, and you've actually seen PE multiples decline from here. So if we're going into the mid-cycle transition, maybe PE multiples need to move down a little bit, which will cause that 5% correction. But ultimately, if we do get a 5% correction, we think it would be a buy the dip type of moment. It's been 189 trading days since the last 5% correction. It's the 15th longest in the past century, so we're probably overdue for it. But again, there's a very strong reason why you want to have exposure to equities at this point in the cycle, because if you look at every bear market since 1949 and the second year following that bear market, during those bear markets where you saw a sell-off of 30% or greater, which happens to be the environment that we're in right now, every single instance in year 2, the market has been up, so 100% hit rate of being positive, and your average return during year 2 is 17.1%. And we entered into year 2 on March 23rd of 2021, so about 4 or 5 months ago. We're nowhere close to that 17% level. Now, last thing I want to end on, and then maybe we'll open it up to Q&A, is the fact that we think that there's actually some more upside for the value trade here. It's obviously been the growth trade for the last 4 months, but as we move into the next couple of quarters, we think fundamentals may favor value. And the reason why I think value may outperform is if you look on the left-hand side, is that valuations are attractive. So we're looking at the Russell 1000 growth PE minus the Russell 1000 value PE since 1995. The average difference has been 7.9%. We're at 7.9 turns. We're at 11.6 turns. Just to get back to the average, we need to see PE multiples come in by about 3.5, and each PE multiple equates to 4 to 5% of relative outperformance. So if we get back to the average, that means value will outperform by 15 or 20%. But the other reason why we're optimistic is the chart on the right-hand side, is that earnings growth is expected to be double that of the growth complex for value for 2021. And although growth has higher revenue growth, if you've seen this clearly in quarter 2's results so far, value is outperforming on the earnings front by a wide margin, expected to do so in Q3, Q4, and into Q1 of next year because of better margins and higher operational leverage. So again, we think value could get its day back in the sun over the next couple of quarters. What I think is interesting also here is that if you look at since the Pfizer announcement of last year in November through March 31st, which is the peaking out of the 10-year Treasury, small outperformed large, value outperforms growth by a pretty wide margin. Since rates had peaked on March 31st through the end of last month, you've seen the opposite dynamic. Large has outperformed, as has growth. But what I think is important to note is that after that vaccine announcement, when small and value outpaced, that was driven by both multiple expansion and improving earnings. That's a very good dynamic. And since Q2, when you've seen large and growth outperform, that outperformance was driven entirely by multiples, and earnings continue to favor small caps and value, not necessarily the best foundation for sustained leadership for the growth in the large complex. But one thing that obviously that we're watching very closely here is what's happening in the rates market. The rates market, the 10-year Treasury market, has completely influenced leadership since the beginning of 2020. We're looking at the NASDAQ, which is a proxy for growth. We're looking at the Russell 2000 as a proxy for value. You can see here that they're mirrored each other really over the last year and a half. And if we do finally get a bottoming out of the 10-year Treasury because of those technical issues, you get more synchronized global growth, China starting to ease on the margin, that all could be a catalyst for the 10-year Treasury to rise, and obviously a bid back into the value cyclical complex. So just, thinking about everything and summarizing, and I'm going to turn it over to Lindsay here. We're positive on the U.S. economy. We think the consumption aspect will be above trend for the next couple of years. We also think that the handoff is moving over to business investment, whether it's inventory restocking, CapEx, but also infrastructure plans that are coming to the U.S. We think that inflation is certainly transitory, but may be more protracted than what people are anticipating. We think the 10-year Treasury could rise, certainly we're overdue for maybe a 5% pullback in the markets, but we're not as concerned about peak economic activity and peak earnings growth. But ultimately, we think value looks attractive at this point in the cycle, especially after the washing out that we've seen over the last 4 months. So with that, I'm going to turn it over to you, Lindsay, and see if we could open up to Q&A. So Lindsay, take it away.
Sure. So thanks, Jeff and Josh. That was terrific as always. We do have a growing list of questions here, so we'll go ahead and kick off the Q&A session. And Jeff, maybe you could touch on this one, and Josh, please feel free to add in any comments as well. Looking at manufacturing, any thoughts on when those jobs will return to the U.S.?
Yeah, I think obviously many companies are rethinking global supply chains. They want to make them shorter, closer to home, especially with the disruptions that we're seeing right now. I don't necessarily think they're going to make their way to the U.S. Obviously, there's record job openings right now. There's certainly a lot of labor slack out there, but I think it would probably be more attractive for these companies to relocate those manufacturing jobs to, say, Canada or Mexico, somewhere a little bit closer to home, but with lower wages that they'd have to pay out. So I don't necessarily think we're going to have a manufacturing renaissance, but I think you will see it benefit a lot of the countries that are here in North America and potentially South America as well. I don't know, Josh, if you have anything else to add to that.
No, I totally agree. I think it's going to probably benefit Mexico the most of anyone. I think one of the things that we watch for this is machine tool orders. That's the stuff that goes into a factory, and you're not really seeing anything crazy on that front that would suggest you have this big sort of domestic manufacturing build out where people are going and pouring money into factories. They have to be buying equipment to put into those factories, and we're just not seeing evidence of that right now.
And one thing I'll just quickly mention is that, with robotics and obviously 3D printing, if you don't necessarily need as much labor, you may see some manufacturing come back to the U.S., but it may not create more manufacturing jobs over the long term that are going to work in those factories.
Got it. And kind of switching gears here to address our next two questions on President Biden. Any thoughts on the proposed cap gains tax and its impact on CapEx growth?
I don't think it's going to have, an effect on CapEx growth. I mean, they talked about doubling the cap gains tax. I think that's a very, very slim possibility. There's really no appetite for that with the moderate Democrats that are out there. I think the cap gains tax will rise, but it'll probably go to 28%, maybe 26%, which will certainly affect the attractiveness of the equities versus other asset classes, but I don't think it's going to affect the attractiveness all that much. what may happen, you may see a little bit more of a sell-off as people try to lock in those cap gains at the end of the year, depending on whether or not it was going to be pushed back to when the package was announced or whether or not it's going to be when it goes into effect. But ultimately, I don't think it's going to affect CapEx, broadly speaking, and I think it's going to be a very small rise of the capital gains tax than what's currently being proposed.
Great. And then kind of as a follow-up to that, we do have a few questions surrounding this subject as well. Any thoughts on Biden's spending plans as it relates to inflation?
Maybe I'll take
yeah,
that.
Yeah, go ahead.
Sorry, go for it. No, as I say, I think the devil's in the details. So I think that this, current proposed package, whether we're talking about the infrastructure package that seems like it's getting close to the finish line, or even a reconciliation bill, I think that the inflationary impacts of these plans as they're being talked about are very different than the stimulus that we've seen over the last 18 months or a little bit longer now. The important thing is that these are, there's large price tags, particularly when we start talking about reconciliation, which could be a couple $1 trillion. But this is spending that's going to occur over, almost a decade period. We're talking 5, 8, even 10 years in some cases. So it's important to keep in mind that this is going to be broken up over much longer periods of time, as opposed to injecting, $1 trillion of capital into the economy, more or less overnight. And then the second part is concept of a fiscal multiplier. So when you effectively hand out cash, as was done during much of the pandemic, and a lot of the focus of those stimulus bills was to get cash into people's pockets, this is a little bit different, where we're creating productive capacity as we're spending this money by building infrastructure. So you have a shift in supply and a shift in demand that's occurring at the same time, as opposed to when you inject capital, you're shifting demand without also creating supply. So I think the overall inflationary impact of the plans as they're being discussed is a fair bit less inflationary than I think common consensus believes. Jeff, I don't know if you have a different view or something to add.
No, I totally agree, and I think it's important to note that we're not going to get 3.5 trillion in spending. Senator Sinema said that she has no appetite for that type of package. The infrastructure package is about $1 trillion in total, 550 billion of which is new spending, and if you spread that over the course of 5 years, certainly going to make a difference on overall economic activity, but I don't think these are large enough numbers to really drive the needle for higher inflation as you look over a prolonged period of time. So you could see it, impact inflation, by a couple basis points, maybe 10 or 15 basis points, but I don't think it's really going to be highly inflationary overall.
Okay. Let's see here. How concerned are you about the Delta variant and then potential for more mutations going forward?
Yeah, I'll take this, Josh. So obviously Delta is, running through the U.S. pretty aggressively at the moment. U.S. is better off than a lot of other areas. 96% of the doses were messenger RNA vaccines, which appear to have better effectiveness than the other vaccines that are out there. But I think we're getting close to the peak at this point. If you look at the trajectory of India, you look at the trajectory of the UK, the peak would suggest that we're probably going to hit that sometime over the next 10 days, give or take. So the key point here is that you've hardly seen an increase of hospitalizations in a lot of the high vaccination states. You certainly have seen a massive surge in the low vaccination states, but at the end of the day, you're going to have mass mandates, but we're not going to go back to lockdowns. And I think we're actually probably pretty close to the end of the Delta variant. So I think that's a key reason why you've started to see equity markets continue to move higher from here. You've seen credit markets come back in after having a minor blowout of spreads. And, as far as, more mutations, I mean, that's very difficult to handicap. There's been so many mutations at this point that it's, it's hard to be able to put a percentage on that, but I would say, given the messenger RNA vaccines and their ability to come up with different variations fairly quickly, if there was a mutation, certainly could see an economic dislocation, but I think you'll be able to get things back on track a lot quicker than what we saw with the first variation.
Great. Was this really a recession in this past recession, or would you more consider it and attribute it to the shutdown?
I would say it's a recession, right? You saw a resetting of obviously the employment situation. Unemployment rate went up 13 percentage points, or give or take. I certainly think it was a recession. But I think the policy response was critical in limiting the structural damage in the economy. Congress acted in lightning speed. The Fed came out with systems to backstop risk. And I think although this is going to be a very different recovery than what you would normally associate with a recession because you don't have that structural risk, it very much was a recession and a deep one at that. I don't know, Josh, if you have anything you want to add to that.
No, I agree. It definitely was a recession. I think history doesn't repeat it, does rhyme. There are some similarities to the 1970s oil embargo, where you had kind of a shorter, somewhat severe recession. It was similarity in the supply shock likely causing it in terms of COVID, being treated as supply shock and then ultimately morphed into more of a demand shock. But yeah, I think, as you said, unemployment rate spiked. You had kind of all the classic hallmarks. If you were to line up, what does a recession look like? You check almost all the boxes, if not every single one. And as you said, I think the policy response was critical in making it so short. It was just 2 months, as I think the question noted. But ultimately, yeah, I would count it as a recession. But given the unique nature of it, as you alluded to, there's also going to be a very unique and kind of different path to the recovery.
Great. And then, looking into 2022, are there any areas in equities that you're seeing in the next 12 months that will be the best performing areas, whether that be U.S., international, emerging markets?
Well, based on my comments, I'm clearly positive on the U.S. equity markets. But, I think if I had to pick out of the three, I would actually pick developed ex-U.S. You look at the Eurozone, their vaccination efforts have actually surpassed the vaccination efforts here in the U.S. The Eurozone is going to deliver strong growth. Their earnings are going to be strong. It's cheap. The recovery fund is starting to be implemented here in the summer. And more importantly, it's a value-oriented stock market. And as you have more and more countries come online and you have a synchronized growth picture as you move closer to 2022, I think that's really going to supercharge the earnings potential of Eurozone companies. And basically, that same exact outlook could be applied to Japan as well. Getting through their COVID outbreak and the political uncertainty, they're a traditional global cycle play, value tilted, valuations are attractive. You don't have very strong positioning there. So I do like the U.S. markets. I just think the developed ex-U.S. is probably more attractive on a relative basis for at least the next, call it 6 to 9 months. And then if you look at EM, EM really keys off of China, and China's obviously had that crackdown recently from a regulatory standpoint, which has been holding back those markets. They have been tightening policy for quite some time. So I think if you're looking at EM over a 12-month time frame, sure, I think that's a pretty attractive market, but you could have some waves or some volatility here in the near term until they can find their footing.
Sure, that's great. And then maybe to wrap things up here, and on a similar theme, how much of the good news has already been kind of baked into equity markets for the rest of the year?
I can start off, Josh, and maybe kick it over to you.
Sure.
All right. So obviously there's earnings have been on a tear, right? You've seen forward earnings projections continue to advance after 4 quarters of enormous beats. With second quarter of last year, third quarter, fourth quarter, first quarter. Consensus estimates so far here for Q2, they've been raised substantially and they're way too conservative. You might have a record of earnings beats of 87% if we can continue this pace through the end of this earnings cycle, right? You're seeing earnings come in 16% above expectations. To put that in perspective, over the last 15 years, that earnings has been beat by about 5%. And this is after, a year of continuing to outperform and a very large move higher of earnings expectations. So there will be eventually a time where the rubber hits the road and S&P 500 companies are going to start missing expectations. But I actually still see some more upside over the next couple of quarters, even though earnings revisions, they're at record levels right now. They're probably going to come down a little bit, but I still think they're going to remain elevated and maybe more importantly, not move back into negative territory more persistently. So yes, there's been a lot of good news that's priced in, but I still think that people are underestimating the earnings potential of U.S. companies in this environment.
And I just add, it's not just the earnings potential that's underestimated. I think the economic potential is underestimated too. We've seen very healthy upward revisions to GDP expectations. If you talk to whether Wall Street or professional academic economists, and I would actually extend this to earnings expectations, almost no one has any stimulus built into their numbers. It's sort of an upside scenario, but it's not in anyone's base case. It's on the radar screen, but it's not really fully being reflected or priced yet. And you can look at that in the revisions data. You can look at it, as I just mentioned, talking to economists. And the last one is you can look at sort of the tracking baskets of companies that would do better or worse under a stimulus bill being passed. And there's been a little bit of movement, but really not very much. It's come more lately as the infrastructure bills come closer to the finish line. But I don't think everything is fully priced in. And then finally, I think there's just still a lot of fear out there that markets ultimately climb a wall of worry, whether it's the things we've talked about, inflation, Delta. There's a number of sort of, I hate to say known unknowns, but there are a number of worries out there that ultimately, if the worst case scenario doesn't come to fruition, I think that can create some upside as those kind of left tail events ultimately get priced out and don't happen.
Excellent, thanks. So I think that will kind of be our closing question here, as we are right up to the hour. And we covered a lot of ground today, so I just wanted to thank you guys for your information and your insight. As always, it was terrific. As a wrap up here, if we didn't get to your question, a ClearBridge representative will be in touch with you in the coming days. And then lastly, a replay will be available, I believe will be in the next 48 hours or so. So thank you again, Jeff and Josh, and to all those on the line for your time. Have a great week and enjoy the rest of the summer. Thank you.
Thanks, Lindsay. Thanks, everybody.
Thanks, everyone.